The Money Show.
Personal Finance with Warren Ingram.
So, Warren Ingram tonight, the topic inspired by a conversation I had a couple of weeks ago in celebration of a remarkable individual's remarkable work anniversary. That remarkable individual is David Shapiro, who many of you will know as a remarkable communicator in the world of investing in shares, in stockbroking, an incredibly generous man and a very kind spirit who has educated generations of people, particularly people in media like myself, a long time ago, with patience and kindness for a very, very long period of time. But he said something in that interview where we just paid a very brief tribute to him that freaked out a friend of mine. A friend of mine sent me a message afterwards, after that interview, and he said, "Mhlobo wam, your interview with David Shapiro the other day got me thinking. After 50 years of trading on the JSE, David Shapiro says this, George."
The worst thing is I still have to be here, I still have to work. And that's an admission. I wish I didn't have to. I wish I'd made enough to not to work. But I enjoy it. I really love you know what, Bruce, and I love what we're doing now. I love the conversations. I love sharing my knowledge and experiences.
And so my friend says, I take it to mean that he wants to remain actively employed rather than retiring and downgrading to a day trader, partly for the fun of it and for pocket money while enjoying a well-earned retirement. Do you know why that would be the case? Surely an adult kid, a guy of his kind and his skills, he's made more than he needs. That part of the interview keeps giving me nightmares because I'm under the impression that I'll be able to do what I want once I've taken my kids through education system and have settled the bond. Am I dreaming? So what I'm going to do is Warren Ingram to say, is my friend dreaming? Warren Ingram, because here's a guy who's been working at the forefront of stock markets, who I'm sure has made very sensible financial planning. But after 50 years of work, David Shapiro makes it very clear, I have to keep working. And he's got grown-up kids and kids all over the world, and he likes to travel and visit them. But yeah, it's understandable when somebody of David Shapiro's experience and stature says, I have to keep working. The rest of us schmucks go, hold on a second, what are we missing?
It's such a tricky conversation, Bruce, because I think it's about the lifestyle that you want to live, and then deciding if you've got enough assets to fund that lifestyle. So just very simply, if there is someone out there that spends, let's say, 200,000 Rand a year to fund their lifestyle, the truth is that they probably only need 20 times that to be able to reach financial independence. And maybe to be really generous, you say, well, put a margin of safety on that and say 25 times that. So, quickly doing my calculation while I'm talking to you, that's not a huge amount of money. That's 5 million Rand, which I know is a fortune for a lot of South Africans. But in the context of funding a lifestyle like that, it's not a big amount of money. But make it 2 million Rand a year, and suddenly that becomes an asset base of 50 million that you need. And so when we talk about someone getting to financial freedom, is it a case, and neither you nor I know anything about David's position. So I mean, I'd hate to make this about David, but the point is
simply to illustrate the point that somebody who's been working for an awfully long time, who we respect and we know is responsible and grown up, he's got too many shirts and ties. But that's just that's his one negative. When we did our Make Money Mondays in those days, he had to admit that he had a penchant for spending money on shirts and ties. But otherwise, travel was his most important thing. But let's move away from David and let's talk about the principles of ensuring that you are able to retire one day at an age where you can actually enjoy the fruits of your labor that you've worked so hard to achieve over so long. And so
then we get to the point that you need to eliminate the role of luck in your whole kind of financial planning. And the way to do that is to make sure you control what you spend, because controlling what you spend dictates how much capital you need one day when you stop work. And so that example of the person spending 200,000 a year and the person spending 2 million, that's a massive difference in going from 5 million to 50 million. And I would argue for most people in the world, being able to reach financial freedom with an asset base of 50 million rand will require a fair amount of luck. It's not just going to be about discipline and skill as an investor and all of those things. You are also needing to be lucky. But for most of us, if we work over a decent career, being able to retire with 5 or 10 million rand, or maybe 20 million rand, will require a lot less luck and can be reached by discipline, making a few trade-offs every now and then and controlling your expenses. So listening to the question that was sent to you by your friend, I do think your friend's dreaming a little bit, because if your goal is, I'm going to educate my kids and pay my bond and I'll be fine, I'm very sorry to tell you that's not fine. You're not fine. You're on your way to being fine, and it's well done. You've reached some goals, but what you haven't done is build up the assets. And let's use the example. You get to your 10 million rands worth of assets so that you can pay your cost of living one day when you're no longer earning an income. And I think that's the point that a lot of people miss here, is they're so focused on the today and the immediate tomorrow, and they forget about their future selves. And that's the part that's bugging me with this whole conversation for a lot of people out there, is they focus on a lifestyle asset like a home. And yes, you've got to pay off your bond. It makes all the sense in the world. But your home's not going to generate any kind of income unless you're renting out, every single room in the house and you live in the tent outside. So the truth is you're going to have to get assets that generate you an income as well. And unless you've said to the kids, listen, I'm going to educate you and then you're going to look after me in retirement, they're not your income plan either. So that's the part, that I think we need to get people to focus on, is you've got to look after yourself as well. And that means build up the asset base that covers you.
And again, it's not, looking after yourself is not a selfish act. Looking after yourself is the kindest thing you can do for your children, for your family, for your extended family, because you do not want to become a burden on those that are younger than you, those that are healthier than you. You want to be able to ensure that you are self-sufficient and able to look after yourself. This idea of looking after yourself is not a selfish act. In fact, it's a massively selfless act, provided you're doing it to alleviate pressure later on.
Well, I think we get a great example of this from the airline industry, and it's top of mind for me, because I was not forced, but I embarked on my first flight since COVID started, and to go and see some of our clients. And sitting in the plane, I duly listened to the air hostess explain the safety briefing, and the thing that struck me was her saying, remove your COVID mask. And if there's an emergency, let's say, be clear, if there's an emergency, remove your COVID mask, put the oxygen mask, which will fall from the roof of the plane, on yourself first before you help anybody else. Now, that's in no way a selfish act. What that's saying is you need to be in a position to have enough oxygen so that you can help the friends, family, children around you. And that's the truth around money as well, is you need to be in a position where you're not a victim of financial disaster, because you've taken care of yourself, so that you have the financial oxygen to take care of everyone around you. And I think a lot of the time, that's what happens here. That would be the one question I'd love to ask David is, are you still working because you spent all your money looking after your kids and friends and family? Because that would make a lot of sense to me. But that's the reality for a lot of people in our country, is that they're under huge financial strain because they're there to look after everyone else as well, which is a good family responsibility and a good ethic, but missing the point that they've got to look after themselves in the process.
Considering how few jobs there are and how few people are actually employed, and the huge level of dependency through nobody's fault, other than they've been badly let down by poor economic policy making decisions and by the rank theft of the fiscus. I'm bored of myself already. It's other than it's not their fault that they're out of work. It's just that the system has let them down, and so therefore those that are in work are left carrying the can. In a moment, I want to talk to you, Warren, about another issue, and that is shares and positioning portfolios. Because if we are going to be talking about financial independence and becoming more self-sufficient, we need to understand the way of the world and stock markets and things at the moment. And I would like to pick up on that with you in just a bit.
The Money Show. Personal finance with Warren Ingram.
A huge amount of volatility in stock markets around the world. Deep uncertainty, Warren. Interest rates are going up across the globe. We've seen 2 rate hikes here. We anticipate the Americans are going to do the same. The Russians are sitting tap dancing on the border of Ukraine. The Chinese economy sort of from month to month looks like it's teetering on the brink of disaster to recovering in huge demand for iron ore. How are we in this world of great unpredictability and uncertainty meant to be thinking about investing?
I think we also just need to add to that part of the question, casting our minds back, a couple of years ago to when, and I'm going to call them quacks, so it's my word, but I know you had some other choice ones for them, all fair. People standing up, and saying, look, cash in your retirement funds, send all your money out of South Africa. The JSE is a basket case, and invest everything globally. And subsequent to that, we've seen the JSE deliver some fantastic returns. And yes, the global markets have done the same, but 2022, that story is very different. 2022, we're seeing, tech shares falling out of bed, the JSE actually not so bad, and the Rand, depending on the second, I think not even the minute, somewhere below 15 Rand to the dollar. So I think when we look at the situation now, be really careful of kind of getting caught into any kind of hype and fear mongering from talking heads who have a completely different agenda to you, which is, for most of us, our agenda is we want to kind of get to financial freedom as fast as we possibly can. The person selling you a story might have a completely different agenda. And in that context, I think when you make a decision about investing in growth assets, and for me, growth assets are generally going to be, shares on the stock exchange. And you can argue property sometimes, but most of the time it's shares on the stock exchange. If you're going to make a decision like that, one of the things you're going to have to decide is, are you buying shares when they are good value? And always, when people look at value, that they might get misdirected by saying, well, the price has been shooting up for quite some time, so the thing must be expensive now. The stock market must be expensive. And last year would be a case in point. The JSE was up 29% over the calendar year. So a lot of people might be tempted to say, okay, that means it's now expensive. That's not true. What you need to look at is something different. And there are a whole lot of metrics, and the stockbrokers and fund managers love to complicate this. But a fairly simple measure that you can kind of Google is, what is the PE ratio of the market? And we don't have enough time to explain all of that in the show.
If you take last year's profits of all of the shares on the JSE and you say, how many times more, how much more am I expected to pay than last year's profits? I'm expected to pay twice as last year's profits. Then the market is incredibly cheap. 10 times last year's profits, that's still quite cheap. 15 times, it's getting pricey. 20 times, don't like that. 25 times, no, hold on a second, the market's expensive. It's the multiple of last year's profits that we're talking about here, that's all.
Fair enough. Nice and simply explained. Thanks, Bruce, you saved me there. So I think when you look at the JSE, the PE ratio you're looking for is around about 15. If it's below that, and obviously the further below that, the cheaper it goes. If it's above that, you're in expensive territory. Take 30 seconds to Google it, and you'll see that it's around about 12 now, the PE of the JSE. What that's telling you is that it's still cheap. It's cheap after it's delivered a return of 29% for last year. So that's telling you that putting money into something that is cheap, and it's an entire index. We're not too worried about choosing individual companies here and saying, no, well, hang on, it's cheap because that company is about to fall over. There might be reasons why individual companies are cheap, but looking at the whole market, much easier to make a fairly good view on what's going to happen in the future. And when the JSE is at these levels, the likelihood is it's giving you 15 or 20% a year for the next 3 or 4 or 5 years. And not a guarantee, of course, but that's a decent return to get without having to apply your mind too much. Yeah. When you look at the developed markets, they've fallen over a bit, and they're currently at a PE of 22. And as you said, Bruce, when you're sitting at P's of 20s, that's telling you, look, this is not a great time to kind of deploy all your money and expect to get double your return every year for the next few years. It's likely that you're not going to get a great return for the next few years.
Nicely put. Thank you, Warren Ingram. In a moment, I'd like you to explain to me this question. I would like to know, what's momentum investing? Is it opposite to Sanlam investing or Old Mutual investing? You know what I mean. Momentum investing. That question in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So, Warren Ingram, what is momentum investing?
As you pointed out, nothing to do with insurance companies. Momentum investing is when traders, especially traders, but sometimes fund managers as well, will look at a market or a share and realize that there is a huge positive sentiment to that market, and people are buying up and pushing the price up on a big sustained basis. And so a momentum investor will be tracking things like how many shares are being sold. Is there a lot of volume in this, and is there a big sort of popular demand for this share? If there is, then they'll buy in, basically aiming to ride the tide of that rising share price. The goal then is to sell out before the tide goes out again and the momentum stops.
So the FANGs stocks that were so famous up until about a year ago, they were momentum shares. They were just going up and up and up and up. Facebook and Amazon and all of the other FANGs, Netflix and all of these things, which could show no weakness whatsoever. When the sell-off started, it was very, very quick and very, very painful, and we've seen a massive destruction of value. That's what you mean when it means getting out on time.
Exactly right. And it's not about, people trying to determine value or doing major calculations. It's just about riding the tide and then hopefully timing it well enough that you get out. And as you point out, if you get it wrong, you end up losing 30% in a day.
Yeah, and that's why you've got to be careful of people selling hot trends and hot ideas, and look at the history of the last 5 years. And sort of people extrapolating that forward. That's what you've got to be cautious of, and I think that's your warning.
Absolutely, and I think often you've got to be a little bit contrarian in this whole thing and look at where people are not going to, the unloved parts of the investment markets, because that's really where the good value is and where the opportunities will be.
And you can wait an awfully long time on the sidelines of that particular game. But that's a discussion for another day. Warren Ingram, thank you. He's a director at Galileo Capital. He's a personal